Right now, as you sit there watching this video, millions of home buyers across the world are overpaying on their mortgage, and they don't even know it. A study published in the Journal of Real Estate Finance and Economics found that total mortgage overpayments exceed $13 billion every single year in America alone. That is not a typo. 13 billion. And the worst part? Most of this money is lost simply because people do not understand how mortgage rates work. So today, we are going to fix that. This is not a quick overview. This is a full course. By the time this video ends, you will understand mortgage rates better than most people who already own a home. You will know exactly how rates are set, what makes them go up and down, and most importantly, how to make sure you get the lowest rate possible. And later in this video, I'm going to show you a trick that can save you over $60,000 on a single loan. So stay until the end. Now, let me be clear. Freddie Mac data tracked since 1971 shows mortgage rates have averaged around 7.8% over the past 5 decades. That means if you're getting a rate in the low sixes right now, you're actually doing better than most people in history. But better than history does not mean you can't do even better. So let's get into it. So first, what is a mortgage rate? A mortgage rate is simply the cost of borrowing money to buy a home. Think of it like rent on someone else's money. When you go to a bank and say, "I want to buy this house for $300,000, but I only have $60,000," the bank says, "Fine, we'll lend you the other $240,000, but you have to pay us back with interest." That interest is your mortgage rate. If your mortgage rate is 6% on a $240,000 loan, you are not just paying back $240,000. Over 30 years, you will pay back much more than that. The interest adds up month after month after month. And here's where it gets crazy. On a standard 30-year loan at 6.5%, you could end up paying almost double the original amount by the time you're done. That is why understanding mortgage rates is not just nice to know. It is essential. Every fraction of a percent matters. Every quarter of a percent can mean tens of thousands of dollars over the life of your loan. And this is why we are here. So let's break down the types of mortgage rates first. There are 2 main types of mortgage rates you need to know. The first is called a fixed rate. A fixed rate means whatever interest rate you agree to on day 1 stays the same for the entire life of your loan. So imagine you lock in at 6.2% in January 2026. 10 years later, even if rates jump to 9%, you're still paying 6.2%. That's the beauty of a fixed rate. It is predictable, it is safe, it does not change. The second type is called an adjustable rate mortgage, or ARM. An ARM starts with a lower rate than a fixed mortgage, but that rate can change after a certain period. So imagine you get an ARM at 5.5% for the first 5 years, but then in year 6, the rate jumps to 7.8% because the market changed, and you're now paying way more than you planned. According to Freddie Mac, fixed-rate products have dominated the mortgage market in recent years. And for good reason. People want certainty. Now, ARMs are not all bad. If you plan to sell the house within 5 years, an ARM can actually save you money because you benefit from that low initial rate without ever hitting the adjustment period. But if you plan to stay long-term, a fixed rate is almost always the safer choice. Keep this in mind because later, I will show you exactly when each type makes sense for your situation. The most popular mortgage in America is the 30-year fixed rate. This means you borrow money and pay it back over 30 years with the same interest rate the entire time. Research from homebuyer.com analyzing HMDA data showed that conventional loans captured 70% of the entire mortgage market in 2024. 7 out of every 10 homebuyers chose this path. But why 30 years? Well, spreading payments over a longer time makes each monthly payment smaller. Instead of paying $3,000 a month on a 15-year loan, you might pay $1,800 a month on a 30-year loan. That makes homeownership accessible to more people. But here's the trade-off. You pay far more in total interest over 30 years than you would over 15. This is where most people get confused. They look at the monthly payment and think, oh, that's affordable. But they don't calculate the total cost. And that total cost is where the real money hides. A 15-year mortgage has a lower rate and you pay much less total interest. But the monthly payment is higher. So it's a balancing act between what you can afford now versus what you'll pay later. And we'll get deeper into this soon. Okay, here is where it gets really interesting. Most people think the bank just makes up your mortgage rate. Like some person in a back office says, let's give this guy 6.5%. That's not how it works. Your mortgage rate is shaped by multiple forces, and understanding these forces gives you power. According to Fannie Mae's research division, mortgage rates are primarily tied to the 10-year U.S. Treasury note, not the Federal Reserve rate directly, but the 10-year Treasury. Why? Because a 30-year mortgage has a similar duration to this bond. So when investors demand higher returns on the 10-year Treasury, mortgage rates go up. When investors accept lower returns, mortgage rates come down. Think of it like this. The government sells bonds to borrow money. Investors buy those bonds for a guaranteed return. If investors get nervous about inflation or the economy, they want higher returns to take the risk. And since mortgage lenders compete with those same bonds for investor dollars, they have to offer higher rates too. This is the secret most people never learn. It's not just the Fed, it's the bond market. And we're about to go even deeper. Now, the Federal Reserve. Everyone talks about the Fed. The Fed raised rates. The Fed cut rates. But here's the truth that Charles Schwab's research team confirmed. The Fed does not directly set mortgage rates. The Federal Reserve controls something called the federal funds rate. This is a short-term rate that banks charge each other to borrow money overnight. So wait, if the Fed doesn't set mortgage rates, why does everyone act like it does? Because the Fed's decisions influence the entire economy. When the Fed raises the federal funds rate, borrowing becomes more expensive for banks. Banks then pass those costs to you through higher mortgage rates. When the Fed cuts rates, borrowing gets cheaper, and mortgage rates tend to drop, eventually. But here's the key. According to CBS News reporting on expert analysis, the 10-year Treasury yield has a greater and more direct impact on mortgage rates than the federal funds rate. As one expert put it, by the time the Fed actually makes a move, the bond market has already priced in the expectation weeks or months ahead. So the real players are bond investors, not just the Fed. Remember this. If there is one word you should tattoo on your brain when it comes to mortgage rates, it is this: inflation. Inflation is when the prices of everything around you go up. Your groceries cost more, your gas costs more, your rent costs more. When inflation is high, mortgage rates go high. When inflation is low, mortgage rates come down. Why? As Rocket Mortgage explains in their research, when prices rise, the Federal Reserve raises the federal funds rate to try to get inflation under control. And as the Fed tightens, the entire borrowing environment becomes more expensive, including mortgages. We saw this happen in real time. In 2022, inflation surged, and according to Freddie Mac, the 30-year rate shot past 7% for the first time in over 20 years. But here's what makes it even more complicated. Even if the Fed cuts rates, inflation expectations can keep mortgage rates high. That's exactly what happened in late 2024. The Fed cut rates 3 times, but mortgage rates barely moved because investors still expected inflation to stay sticky. So it's not just what's happening now, it's what the bond market thinks will happen in the future. Okay, I know the bond market sounds complicated, but let me make it simple for you. A bond is like an IOU from the government. You give the government money, and they promise to pay you back with interest. The 10-year Treasury bond means the government pays you back over 10 years. Now, when the economy is doing great, and people feel confident, they pull money out of bonds and put it into stocks because stocks make more money. When money leaves bonds, bond prices drop, and the interest rate on those bonds, called the yield, goes up. And since mortgage rates follow the 10-year Treasury yield, mortgage rates go up too. But when the economy looks scary, like during a recession or a global crisis, investors run toward bonds because bonds are safer. More money flowing into bonds pushes bond prices up, which pushes yields down, which pushes mortgage rates down. This is exactly what happened during COVID in 2020, when mortgage rates fell below 3%, because investors were terrified and flooded into bonds. So the bond market is like a mood ring for the economy, and mortgage rates follow that mood. Now let's talk about something you can actually control: your credit score. This is huge. According to data from FICO compiled by myfico.com, the difference between a high credit score and a low credit score on a mortgage can save you over $62,000 in interest over the life of a $300,000 loan. $62,000 just because of your credit score. Here's how it works. Lenders see your credit score as a report card of how responsible you are with money. Research from Experian shows that as of January 2026, someone with a credit score of 700 averaged a 6.58% mortgage rate. But someone with a score of 760 or higher could qualify for rates significantly lower. That gap might seem small on paper, but over 30 years, it is massive. Data analyzed by refi.com using FICO figures shows that for every 20-point drop in credit score below 760, your interest rate jumps by roughly 0.2%. And once you fall below 660, the jump is more than double that. So imagine you have a score of 640 and you're paying 7.8%, while your neighbor with a score of 780 is paying 6.4% on the exact same house. Over 30 years, that neighbor saves enough to buy a brand new car, maybe two. So what makes up your credit score? According to analysis from AD Mortgage, your FICO score is built from 5 components. The biggest one, payment history, accounts for 35% of your score. This is simply whether you pay your bills on time. Late payments hurt you. On-time payments help you. It's that straightforward. The second biggest factor is the amount you owe at 30%. This is called your credit utilization ratio. If you have a credit card with a $10,000 limit and you've used $8,000 of it, that's 80% utilization, and that tanks your score. But if you only use $2,000 of that $10,000, you're at 20% utilization, and lenders love that. The remaining 35% is split between length of credit history at 15%, credit mix at 10%, and new credit inquiries at 10%. Here's a quick secret. Closing old credit cards actually hurts your score because it shortens your credit history and increases your utilization. So even if you're not using an old card, keep it open. These small details can push your score up by 20 to 40 points within just a few months, and that can change your mortgage rate dramatically. All right, so how do you improve your credit score before applying for a mortgage? Here are the most effective steps. First, according to a Consumer Report study cited by AD Mortgage, 44% of consumers found at least one error on their credit reports. That means almost half of all people have mistakes dragging their score down. Go to annualcreditreport.com right now, get your free report from all 3 bureaus, and dispute any errors. Second, pay down your credit card balances to below 30% of your limit. This single action can boost your score by 20 to 40 points in just 60 to 90 days. Instead of keeping $5,000 of debt on a card with a $7,000 limit, pay it down to $2,000. That shift alone changes your utilization from 71% to 28%, and your score responds fast. Third, and this one catches people off guard, Do not open any new credit accounts or make big purchases before applying for a mortgage. Buying a new car 2 months before your mortgage application is one of the most common mistakes people make because it adds a hard inquiry and increases your total debt. Lenders look at your full picture, and that new car payment changes your debt-to-income ratio. Stay quiet financially in the months leading up to your mortgage application. Your down payment is another massive factor in what rate you get. The more money you put down, the less risk the lender takes, and the lower your rate will be. A 20% down payment is the golden number. According to Liberty Bank's analysis, putting 20% down typically results in better rates and eliminates the need for private mortgage insurance, or PMI. What is PMI? PMI is an extra fee the lender charges you when you put less than 20% down. It protects the lender, not you, in case you stop making payments. PMI can add anywhere from $50 to $200 per month to your mortgage payment. Over several years, that's thousands of dollars going to something that provides you no benefit. Now, saving a full 20% for a $300,000 house means you need $60,000 in cash, and for many people that feels impossible. But here's the good news. Even going from 5% down to 10% down can get you a noticeably better rate. And some loan programs like FHA loans let you start with as little as 3.5% down. The point is, every extra dollar you put down works in your favor. We'll talk about these loan types next. The Federal Housing Administration, or FHA, backs a special type of mortgage designed for people with lower credit scores or smaller down payments. Chase Bank's Mortgage Education Center explains that you can qualify for an FHA loan with a credit score as low as 580 with just 3.5% down. If your score is between 500 and 579, you still qualify, but you need at least 10% down. FHA loans are incredibly popular with first-time homebuyers who haven't had time to build a massive savings account or a perfect credit score. But there's a cost. FHA loans require mortgage insurance for the entire life of the loan, not just until you reach 20% equity like conventional loans. This can make them more expensive in the long run. So, when does an FHA loan make sense? When you're a young professional who just started working 2 years ago, your credit score is around 620, and you've saved $15,000. An FHA loan gets you into a home now instead of waiting 5 more years. But the moment you build enough equity and credit, you should refinance into a conventional loan to drop that insurance payment. This is a strategy, not a permanent plan. Now, if you're a military veteran or active duty service member, you have access to something incredible: the VA loan. VA loans are backed by the Department of Veterans Affairs, and they often require 0 down payment and no private mortgage insurance. According to Homebuyer.com's research, VA mortgage rates averaged 19 basis points below FHA rates and 65 basis points below conventional rates in 2024. That means veterans are getting some of the best deals in the entire mortgage market. If you've served and you're not using a VA loan to buy your home, you are leaving money on the table. Serious money. The savings over 30 years can be tens of thousands of dollars compared to a conventional loan. And then there's the USDA loan for rural and suburban home buyers. These also offer 0 down payment options. The catch is that the property must be in a USDA-eligible area, and your income must fall within certain limits. But if you qualify, it's another powerful way to buy a home with minimal upfront cost. The point is this: know all your loan options before you commit. And I promise, the best tip is still coming later. Let me explain something that quietly costs people hundreds of thousands of dollars: the length of your loan term. 15 years versus 30 years has a huge impact on your total cost. A 15-year mortgage always comes with a lower interest rate than a 30-year mortgage. That's because the lender gets their money back sooner, so they charge you less for the privilege. Imagine you borrow $300,000 at 6.5% for 30 years. Your monthly payment is about $1,896. Total paid over 30 years? Roughly $682,000. Now take that same loan at 5.9% for 15 years. Monthly payment jumps to about $2,512, but total paid? Only about $452,000. That's a savings of over $230,000, just by choosing 15 years instead of 30. Of course, not everyone can afford that higher monthly payment, and that's okay. But if you can swing it, a 15-year mortgage is one of the most powerful wealth-building tools available. And here's a middle ground trick. Get a 30-year mortgage for the lower required payment, but make extra payments toward the principal whenever you can. This lets you pay off the loan faster without being locked into the higher monthly obligation. Okay, this is the part where I need you to really pay attention, because this single piece of advice can save you more money than almost anything else in this video. Shop around. A landmark CFPB study found that almost half of all mortgage borrowers do not shop around before committing to a lender. They take the first offer they get. That's like walking into one car dealership, hearing the price and saying, "Yeah, sure, I'll take it," without checking anywhere else. Further CFPB research found that not comparison shopping costs the average homebuyer approximately $300 per year, and many thousands over the life of the loan. And Fannie Mae survey data confirmed that 36% of homebuyers received only one mortgage quote. And it gets worse. A study from the Philadelphia Federal Reserve found that borrowers' mortgage knowledge and shopping behavior strongly determine the rates they get. People who know more and shop more get better rates, period. It's not luck, it's not connections. It's knowledge and effort, and you're gaining the knowledge right now. So how do you shop for a mortgage the right way? Step 1. Get quotes from at least 3 to 5 different lenders. This includes big banks, credit unions, online lenders, and mortgage brokers. Each one will offer slightly different rates and fees, and you need to compare them all. Step 2. Do all your applications within a 14 to 45-day window. According to credit scoring analysis, multiple mortgage inquiries within this period count as a single hard inquiry on your credit report. So shopping around does not hurt your credit score if you do it within this window. Many people avoid shopping because they're afraid of multiple credit checks, but that fear is costing them money. Step 3. Compare the total cost, not just the interest rate. Look at the annual percentage rate, or APR, which includes fees and points. Research by Kathy Cheng Zhang at the University of Florida found that the average profit markup from mortgage origination fees alone is approximately 51%. That means lenders are charging almost double what these fees actually cost them. Shopping is how you fight back against that markup. Let me introduce you to something called discount points. A discount point is money you pay up front to the lender in exchange for a lower interest rate. 1 point equals 1% of your loan amount. As the mortgage reports explains, 1 discount point can lower your interest rate by about 0.25%. So imagine you're borrowing $400,000. 1 discount point costs you $4,000 at closing. But that 0.25% lower rate saves you money every single month for the entire life of the loan. Over 30 years, those savings far exceed the $4,000 upfront cost. It's like paying a small fee today to get a permanent discount forever. But, and this is important, points only make sense if you plan to stay in the home long enough to recoup the upfront cost. If you buy a house and sell it 3 years later, you probably won't break even on those points. The general rule? If you plan to stay at least 5 to 7 years, buying points is usually worth it. If you might move sooner, skip the points and keep your cash. Here's another tool most first-time buyers don't know about: the rate lock. When a lender offers you a rate, You can ask them to lock it in for a specific period, usually 30, 45, or 60 days. This means even if rates go up during that period, your rate stays the same. Why does this matter? Because mortgage rates can change daily. Imagine you get approved at 6.2% on Monday, but by the time your closing happens 3 weeks later, rates have jumped to 6.5%. Without a rate lock, you'd be stuck paying the higher rate. With a rate lock, you keep the 6.2% you were promised. Now, longer rate locks sometimes come with a slightly higher rate or a small fee. And if rates drop after you lock, you're stuck at the higher locked rate, unless your lender offers a float-down option. Always ask about this. Some lenders will let you take advantage of a lower rate even after you've locked, usually for a small fee. It's like insurance on your rate. And in a volatile market, it can be incredibly valuable. Your debt-to-income ratio, or DTI, is something lenders look at very closely. It tells them what percentage of your monthly income goes toward paying debts. As Chase Bank explains, a lower DTI ratio signals to lenders that you can comfortably handle a new mortgage payment on top of your existing obligations. Here's how it works. Let's say you earn $6,000 a month before taxes. Your car payment is $400, student loans are $300, and credit card minimum payments are $200. That's $900 in monthly debt. 900 divided by 6,000 equals 15% DTI. Now add a potential mortgage payment of $1,800. That brings your total debt to $2,700, or 45% DTI. Most lenders prefer a DTI of 43% or lower for conventional loans. Some FHA lenders will go up to 50%, but the lower your DTI, the better your rate and the more money you can borrow. So before you apply, pay down those debts. That car payment you can eliminate, that credit card you can pay off, each one you remove lowers your DTI and puts you in a stronger position. Mortgage rates don't exist in a vacuum. They are deeply connected to the broader economy. According to Bankrate's analysis, the Fed raised rates consistently starting in March 2022 as inflation picked up. The federal funds rate reached 5.33% by August 2023 and stayed there for over a year. During that same period, the 30-year mortgage rate breached 8%. Then the cycle turned. The economy cooled, inflation started coming down, and the Fed began cutting rates. ABC News reported that by early 2026, the average 30-year fixed rate had fallen to around 6.15%, the lowest level in over 15 months. This happened because the Fed cut rates at 3 consecutive meetings, bringing the benchmark rate down significantly. Understanding this cycle gives you timing power. When inflation is rising and the Fed is tightening, rates go up, so locking in sooner is better. When inflation is cooling and the Fed is cutting, rates trend down, so waiting or planning to refinance later can save you money. You don't need to be an economist, you just need to watch the trend. So where are we right now? According to the mortgage reports, the 30-year fixed mortgage rate averaged around 6.11% as of early February 2026. That's down considerably from the highs we saw in 2023 and early 2024. The trend is positive for homebuyers. Fannie Mae's Economic and Strategic Research Group projected that mortgage rates would end 2026 at approximately 6.2%. Meanwhile, Redfin forecasts that rates will remain in the low 6% range for most of 2026. So while we're not going back to the 3% pandemic rates anytime soon, the direction is moving in your favor. But don't wait for the perfect rate. As Freddie Mac's chief economist Sam Cater noted, the drop in mortgage rates is an encouraging sign for potential homebuyers. And remember, dating back to 1971, the historical average is 7.8%. So the low sixes are actually quite good by historical standards. The key is to get the best rate available today and refinance later if rates drop further. Let me pull back the curtain on something most people never learn about. After a bank gives you a mortgage, they often don't keep it. They sell it. Your mortgage gets bundled together with thousands of other mortgages into something called a mortgage-backed security, or MBS. Investors then buy these bundles for the steady income from all those monthly payments. According to PIMCO's research, the Federal Reserve itself holds massive amounts of MBS on its balance sheet. And here's the kicker. Since 2022, the Fed has been allowing about $18 billion per month in MBS to roll off without replacement. This is called quantitative tightening, and it reduces demand for mortgage bonds, which pushes rates higher. PIMCO argued that if the Fed simply stopped shrinking its MBS holdings and reinvested that $18 billion per month, it could compress mortgage rates by 20 to 30 basis points. That's 0.25%, without even touching interest rates. This shows how much the behind-the-scenes mechanics matter. Your mortgage rate isn't just about you, it's about global financial plumbing. There's one more technical thing you should understand: the spread. The mortgage spread is the gap between the 10-year Treasury yield and mortgage rates. PIMCO's data shows this spread is near historically wide levels right now. Normally, mortgage rates run about 1.5 to 2% above the 10-year Treasury. But in recent years, that gap has been even wider. Why should you care? Because if the spread narrows back to normal levels, mortgage rates would drop even without the Fed cutting rates. It's like there are two doors to lower mortgage rates. One is the Fed lowering the Treasury yield through rate cuts, and the other is the spread itself compressing back to its normal size. Either door opens, and rates come down. This is why some analysts are optimistic about mortgage rates falling further in 2026 and beyond. Even with relatively stable Treasury yields, a return to normal spreads could shave another 1/4 to 0.5% off your rate. Patience and timing can pay off here. But don't be paralyzed by analysis. The best time to buy is when you're financially ready. Before you even start looking at houses, you need to get pre-approved for a mortgage. Pre-approval is when a lender reviews your finances, income, debts, credit score, assets, and tells you exactly how much they're willing to lend you and at what estimated rate. Think of pre-approval as your power card when house hunting. When a seller sees two offers, one from a buyer who's pre-approved and one who isn't, they almost always pick the pre-approved buyer because there's less risk the deal falls through. In competitive markets, showing up without pre-approval is like showing up to a job interview without a resume. Getting pre-approved also helps you understand your budget before you fall in love with a house you can't afford. It forces you to confront the real numbers, what your monthly payment will actually be, how much you need for a down payment, and what closing costs look like. This is preparation, not just a formality. And it puts you ahead of nearly half the buyers who, as we discussed, don't even shop around. Your mortgage rate is not the only cost. Closing costs can add 2 to 5% of the loan amount on top of everything else. These include lender fees, appraisal fees, title insurance, attorney fees, and more. The University of Florida study found that with mortgage fee overpayments exceeding $13 billion annually, these costs are a major source of hidden expense. So on a $300,000 loan, closing costs could range from $6,000 to $15,000, and that's cash you need at the closing table. Many first-time buyers are shocked by this because they focused entirely on the down payment and forgot about these additional costs. Here's the strategy. First, ask for a loan estimate from every lender you talk to. This standardized form shows all estimated costs so you can compare apples to apples. Second, negotiate. Many closing costs are negotiable. Third, look into seller concessions. In some markets, sellers will agree to cover part of your closing costs to get the deal done. Every dollar you save on closing costs is a dollar that can go toward your down payment or emergency fund. Your monthly mortgage payment is usually more than just principal and interest. Most lenders require an escrow account, which collects money each month for property taxes and homeowners insurance. So when you see your monthly payment is $2,000, part of that might be $400 for taxes and $150 for insurance sitting in escrow. This is actually helpful because it forces you to save for these big expenses automatically. Instead of getting hit with a $4,000 property tax bill once a year and scrambling to find the money, you pay a little each month and the lender handles the rest. But it does mean your mortgage payment feels bigger than just the loan itself. And don't forget about private mortgage insurance if you put less than 20% down. PMI typically costs between 0.5 and 1.5% of the original loan amount per year. On a $300,000 loan, that could be $1,500 to $4,500 annually, or $125 to $375 added to your monthly payment. The good news? With conventional loans, PMI drops off once you reach 20% equity. Plan for that milestone and celebrate when it arrives. Let me share one of the most powerful strategies in homeownership: refinancing. Refinancing means replacing your current mortgage with a new one, usually at a lower rate. If you bought your home when rates were 7% and rates dropped to 5.5% a few years later, refinancing could save you hundreds of dollars per month. The general rule of thumb is that refinancing makes sense when you can lower your rate by at least 0.5 to 0.75%. You plan to stay in the home long enough to recoup the refinancing costs, and the math works in your favor. There are closing costs to refinance, usually 2 to 3% of the new loan, so you need to calculate your break-even point. Here's a quick example. If refinancing saves you $200 a month but costs you $6,000 in fees, your break-even point is 30 months, or 2.5 years. If you plan to stay at least that long, it's worth it. If you might move before then, it's probably not. And here's the real genius move. When you refinance, keep making the same monthly payment you were making before. The difference goes straight to paying down your principal faster, building equity at an accelerated rate. Remember adjustable rate mortgages? Let's go deeper. A common ARM is called a 5/1 ARM. This means the rate is fixed for the first 5 years, then adjusts once per year after that. The initial rate on an ARM is almost always lower than a comparable fixed-rate mortgage. Now imagine you're a young professional who got a job in a new city, and you know you'll move again in 4 years. Getting a 5/1 ARM at 5.3% instead of a 30-year fixed at 6.2% saves you almost a full percent for every year you're in that house. Since you're selling before the adjustment period, you never experience the rate increase. Smart move. But here's the danger. Life doesn't always go according to plan. What if you plan to move in 4 years, but then you get married, have a baby, and suddenly that house feels perfect? Except now, year 6 hits and your rate jumps from 5.3 to 7.5%. Your payment shoots up by hundreds of dollars a month. If you ever consider an ARM, make sure you understand the caps, the maximum the rate can increase in any single year and over the life of the loan. Know your worst-case scenario before you sign. This is something every mortgage holder should understand, but almost nobody does. It's called amortization. When you make your mortgage payment each month, that payment is split between two things: interest and principal. In the early years, most of your payment goes toward interest. Very little goes toward actually paying down what you owe. Here's what that looks like in real life. On a $300,000 loan at 6.5%, your monthly payment is about $1,896. In month 1, roughly $1,625 goes to interest and only $271 goes to principal. That means 85% of your first payment is just interest. You barely scratch the actual debt. Over time, the split gradually shifts. By year 15, you're paying roughly equal amounts toward interest and principal. And by year 25, most of your payment goes toward principal. This is why extra payments early in the loan are so powerful. Every extra dollar goes directly to principal, which reduces the amount of interest you'll pay for the entire remaining life of the loan. Even an extra $100 a month in the first few years can shave years off your mortgage. Let me break down the extra payment strategy because this is one of the easiest ways to build wealth with your mortgage. If you have a 30-year mortgage at 6.5% on $300,000 and you add just $100 extra per month toward principal, you pay off your loan almost 5 years early and save over $50,000 in interest. $50,000 from $100 extra a month. And it gets even better. Some people make one extra full mortgage payment per year, sometimes by splitting their monthly payment into bi-weekly payments, which results in 26 half payments or 13 full payments instead of 12. This alone can cut 4 to 5 years off a 30-year mortgage. Now, the key is to make sure your lender applies the extra money to principal, not to next month's payment. When you send extra money, specify that it should go toward principal reduction. Some lenders do this automatically, but others don't. Call your lender and confirm how they handle extra payments. This tiny detail makes the entire difference between saving money and just prepaying future payments. Now let me warn you about something. Refinancing can be a trap if you're not careful. Every time you refinance into a new 30-year loan, you restart the amortization clock. Remember how we said most of your early payments go to interest? Well, if you refinance 10 years into a 30-year mortgage into another 30-year mortgage, you just went from having 20 years left to 30 years again. Think of it like running a marathon. You've been running for 10 miles and you're at mile 10 of 26. Then someone says, "Hey, we'll give you better shoes, but you have to start from mile 1. The shoes are better, but now you have 26 miles ahead of you again instead of 16. The smarter move? When you refinance, try to refinance into a loan with a shorter term. If you've been paying for 10 years, refinance into a 15-year or 20-year mortgage, not another 30. This way, you still get the lower rate, but you don't extend your repayment timeline. You'll save even more money this way. Here's a distinction that trips up many home buyers: the difference between your interest rate and your APR, or annual percentage rate. Your interest rate is the base cost of borrowing, the raw percentage. But your APR includes the interest rate plus additional fees and costs, giving you the true cost of the loan. So you might see one lender advertising 6.0% interest, but when you look at the APR, it's actually 6.4% because they're charging high fees. Meanwhile, another lender offers 6.2% interest with an APR of 6.35% because their fees are much lower. That second lender is actually the better deal overall, even though their interest rate looks higher. This is why the CFPB created standardized loan estimate forms. They require every lender to show you both the rate and the APR, along with all estimated fees. Always compare APR to APR when shopping between lenders. It's the most honest number. The interest rate alone can be misleading because lenders can lower it by charging more upfront in points and fees. Your location affects your mortgage in ways you might not expect. Property taxes vary wildly by state and even by county. In some areas, property taxes might be $2,000 a year, while in others, the same priced home carries $15,000 in annual taxes. That difference alone changes your monthly payment by over $1,000. Insurance costs also depend on location. If you live in a flood zone or hurricane-prone area, your homeowner's insurance could be 3 or 4 times what someone in a low-risk area pays. And in some areas, you might also need earthquake insurance or wildfire coverage as separate policies. Even mortgage rates themselves can vary slightly by location. Homebuyer.com's research found that Davis County, Iowa, averaged the lowest mortgage rates in 2024. Geography matters. So when you're budgeting for a home, don't just look at the purchase price. Factor in the total cost of owning that home in that specific location, including taxes, insurance, and local rate variations. Let me tell you about something called the lock-in effect. This is a phenomenon that has trapped millions of homeowners in recent years. Fannie Mae's research described how existing home sales remained near multi-decade lows, partly because homeowners who locked in rates at 3 to 4% during the pandemic are unwilling to sell and buy a new home at 6%. Imagine you bought your home in 2021 at 2.8% interest. Your payment on a $400,000 home is comfortable. Now you need more space, but selling means getting a new mortgage at 6.2%. On the same loan amount, your payment would jump by nearly $1,000 per month. So you stay put, locked in by your low rate. This lock-in effect has reduced housing supply, which has kept home prices high even as rates rose. It's a catch-22. High rates make buying expensive, but they also reduce supply, which keeps prices elevated. Understanding this dynamic helps you make smarter decisions about when to buy and what kind of market you're entering. If you're a first-time homebuyer, there are programs designed specifically for you. Many states offer down payment assistance grants or low-interest second mortgages. Some cities provide closing cost assistance, and federal programs like FHA and USDA offer low down payment options we already discussed. There are also programs where if you're a teacher, firefighter, or healthcare worker, you can qualify for special discounts through programs like Good Neighbor Next Door from HUD, which offers homes at 50% off in certain revitalization areas. These programs exist to help essential workers live near the communities they serve. The problem is that most people don't know these programs exist. Do your research. Check with your state housing finance agency. Ask your lender what programs you qualify for. Many lenders don't volunteer this information unless you specifically ask. Some buyers have gotten $10,000 to $20,000 in assistance simply because they knew to ask. Don't leave free money on the table. Here's one of the simplest mortgage hacks that saves you serious money. Instead of making one monthly payment, split it in half and pay every 2 weeks. This is called a bi-weekly payment plan. Because there are 52 weeks in a year, you end up making 26 half payments, which equals 13 full payments instead of 12. That one extra payment per year goes entirely to principal. Over the life of a 30-year mortgage, this simple change can shave 4 to 6 years off your loan and save you tens of thousands of dollars in interest. And you barely feel the difference because each bi-weekly payment is smaller than a monthly one.
Here's the catch. Not all lenders offer a formal bi-weekly program. Some charge a fee for it. But you can get the same effect for free by simply making one extra principal-only payment at the end of each year. Or divide your monthly payment by 12 and add that amount to each monthly payment. Same result, 0 fees. Simple, but incredibly effective. I need you to shift your thinking. Stop obsessing over the interest rate alone. What matters most is the total cost of the loan. 2 loans can have the same interest rate, but wildly different total costs depending on fees, points, PMI, and loan terms. Here's a real comparison. Lender A offers 6.2% with $3,000 in closing costs and no PMI. Lender B offers 5.9%, but charges $8,000 in closing costs plus 2 points. On a 30-year, $300,000 loan, Lender A might actually cost you less total money over the life of the loan despite the higher rate. It depends on how long you stay. Always ask yourself 3 questions. What is my monthly payment? What is the total amount I'll pay over the life of the loan? And what is my break-even point if I'm paying higher upfront costs for a lower rate? If you can answer these 3 questions for every offer you receive, you will make the right choice every single time. Timing your home purchase can matter more than you think. Mortgage rates fluctuate throughout the year. According to Freddie Mac data, rates in 2025 ranged from a low of 6.15% to a high of 7.04%. That's almost a full percent difference depending on when you bought. Seasonally, spring and summer tend to be the busiest home buying seasons, which means more competition and sometimes higher prices. Fall and winter can offer less competition, potentially better deals, and sometimes slightly better rates as demand decreases. But don't try to time the market perfectly. Nobody can predict rates with certainty. Even the experts get it wrong. The 2024 forecasts predicted rates would drop to 4.25%, and they didn't come close. The best approach is to be ready financially. Shop during a period that works for your life, and focus on getting the best rate available at that moment. If rates drop later, you can always refinance. If you want to predict where mortgage rates might go, watch these economic indicators.
First, the monthly jobs report. Strong job growth usually pushes rates up because it signals a healthy economy. Weak job growth pushes rates down because it signals potential trouble. Second, watch the Consumer Price Index, or CPI. This is the main measure of inflation. When CPI comes in higher than expected, rates tend to jump. When it comes in lower, rates tend to drop. Third, watch Federal Reserve meeting announcements. The Fed meets 8 times per year, and their language about future rate decisions moves markets immediately. Fourth, watch the 10-year Treasury yield. You can find this on any financial news site, updated in real time. When the yield goes up, mortgage rates typically follow within days. When it drops, rates usually come down too. You don't need to be a financial expert. Just check these 4 things once a week, and you'll have a much better sense of where mortgage rates are headed. Knowledge is literally money here. Governments can directly intervene in the mortgage market. Recent reporting noted that the federal government moved to purchase $200 billion in mortgage-backed securities to help push borrowing costs lower. This kind of intervention directly increases demand for mortgage bonds, which pushes rates down. This is essentially what happened during the pandemic. The Federal Reserve bought massive amounts of mortgage-backed securities, which pushed rates to historic lows below 3%. It was unprecedented government intervention in the housing market, and it created the boom and bust in rates that we've been navigating ever since. So when you hear about government housing initiatives, pay attention. They can move rates in meaningful ways. Programs that increase demand for MBS push rates down. Government spending that increases deficits and debt issuance can push rates up. Both sides of the coin affect your mortgage. Stay informed, because these policy decisions directly impact your wallet. If you're buying an expensive home, you might need something called a jumbo loan. A jumbo loan is any mortgage that exceeds the conforming loan limit set by the Federal Housing Finance Agency. These loans are too large to be backed by Fannie Mae or Freddie Mac, so lenders take on more risk. Normally, jumbo loans come with higher rates. But the mortgage reports noted something interesting. Jumbo loan rates have actually reversed course and stayed below conforming rates in recent periods. This has created great deals for high-value home purchases. However, jumbo loans typically require a higher credit score, usually 700 or above, with the best rates reserved for 780 and above. You'll also need a larger down payment, often 10 to 20%, and strong cash reserves. If you're in jumbo territory, having your financial profile polished is even more critical than with standard loans. Buying a second home or investment property? Your mortgage terms will be different. Homebuyer.com's research found that buyers of second homes borrow 41% more than buyers of primary homes, an average of $521,000 compared to $368,000. Rates on second homes and investment properties are typically higher than primary residence rates, sometimes by 0.25 to 0.75%. Lenders charge more because the risk is higher. If you hit financial trouble, you're more likely to default on your vacation home than on the roof over your head. Down payment requirements are steeper too. While you might put 3.5% down on a primary residence with an FHA loan, second homes usually require at least 10%. And investment properties often need 15 to 25% down. If a rental property is in your future, start building that larger down payment now and keep your credit score as high as possible. Here's something beautiful about the mortgage market. There are thousands of lenders competing for your business. Homebuyer.com data shows United Wholesale Mortgage led all lenders with $91.8 billion in purchase volume in 2024. Followed by Rocket Mortgage with $50 billion. With this much competition, you have leverage. Lenders want your business. That means you can negotiate. If one lender offers a better rate, tell the other lender and ask them to match it or beat it. It's like when you find a cheaper flight on one airline and you call the other airline to see if they'll match the price. Mortgage lenders do the same thing. They would rather lower their profit margin than lose your business entirely. This is exactly why shopping around matters so much. The more quotes you have, the more leverage you have. Walk into every conversation with the knowledge that you have Options. Lenders who know you're comparing offers will work harder to give you a better deal. Competition is your friend. Should you use a mortgage broker or go directly to a lender? A mortgage broker is like a middleman who shops multiple lenders on your behalf. A direct lender, like a bank or credit union, offers you their own products. The University of Florida study found that borrowers who use brokers achieve lower total borrowing costs compared to going directly to one lender. This makes sense. A broker has relationships with dozens of lenders and can find deals you might never see on your own. However, brokers charge a fee, usually paid by the lender or built into your rate. And not all brokers are created equal. Some genuinely work to find you the best deal, while others steer you toward lenders who pay them the highest commission. Always ask your broker how they're compensated and whether they're comparing all available options or just a select few. Transparency is key. Let me give you the exact tiers that lenders use so you know where you stand. According to FICO data compiled by Yahoo Finance, a FICO score of 800 earned an APR of about 6.41% on a 30-year fixed mortgage as of February 2026. That's the top tier. Moving down, analysis from refi.com shows borrowers in the 700 to 759 range pay about 0.2% more. Drop to 680 to 699 and add another 0.2%. At 660 to 679, you add another 0.2%. But below 660, the jumps get much bigger. The 640 to 659 range sees a 0.43% spike, and below 620, you're adding roughly another 0.5% on top of that.
Do the math. The difference between the best and worst tiers is nearly 2 full percent. On a $300,000 loan, that's the difference between paying $682,000 total and paying $800,000 total. $118,000, separated only by your credit score. If that doesn't motivate you to improve your credit before buying, nothing will. Big changes are coming to credit scoring. According to Yahoo Finance reporting, Fannie Mae and Freddie Mac now consider scores from VantageScore 4.0 in addition to traditional FICO scores. This could help roughly 5 million Americans qualify for a mortgage or get a better interest rate. Additionally, FICO will soon provide credit scores directly to lenders rather than through credit bureaus. This change, rolling out in early 2026, might lower the costs borrowers pay for credit scores. Whether those savings get passed to consumers remains to be seen, but the direction is positive. What does this mean for you? More scoring options mean more chances to qualify. If your FICO score is borderline, but your Vantage score is higher, lenders now have the option to use the score that works in your favor. Stay informed about these changes because they could make the difference between approval and denial, or between a good rate and a great rate. Let me give you the exact documents you'll need when applying for a mortgage so nothing catches you off guard. First, your last 2 pay stubs. Second, W-2 forms from the past 2 years. Third, tax returns from the past 2 years. Fourth, bank statements from the past 2 to 3 months showing your savings and assets. Fifth, documentation of any other income, rental income, freelance work, investments. Sixth, a list of all current debts with balances and monthly payments. Seventh, identification, usually a driver's license and social security number. And eighth, if you're self-employed, you'll need profit and loss statements and potentially business tax returns. Here's a pro tip. Gather all of these documents before you start the application process. Having everything ready makes the process smoother, faster, and shows the lender you're organized and serious. Delays in providing documentation can slow your closing timeline, and in a competitive market, speed matters. After you're approved and under contract, the lender will order an appraisal. An appraiser is a licensed professional who determines the home's actual market value. The lender needs this because they won't lend you more than the home is worth.
Imagine you agree to pay $350,000 for a house, but the appraisal comes back at $320,000. Now there's a $30,000 gap. The lender will only base your loan on the $320,000 appraised value, which means you either need to come up with that $30,000 extra in cash, renegotiate the price with the seller, or walk away from the deal. This is why having a good real estate agent and doing your own research on comparable home sales matters. You don't want to overpay for a home only to have the appraisal reveal it. And if the appraisal comes in low, use it as negotiating leverage. The seller now knows their home isn't worth what they thought, and that puts you in a stronger position. Closing day is when everything becomes official. You sign the documents, pay your closing costs and down payment, and receive the keys to your new home. But there are things you should know before that day arrives. First, do a final walkthrough of the property the day before or morning of closing. Make sure everything is in the condition agreed upon. Second, bring a cashier's check or arrange a wire transfer for your closing costs. Personal checks usually aren't accepted for these large amounts. Third, read every document before you sign. I know it's a lot of paper, but this is the biggest financial decision of your life. Your closing disclosure will show the final terms of your mortgage, including your exact rate, monthly payment, and all fees. Compare this to the loan estimate you received earlier. If anything changed significantly, ask why before signing. You have the right to question any discrepancy. This is your money and your future. Don't rush through the most important part. Buying the home is not the end of your mortgage journey. Smart homeowners continue monitoring rates even after they close. Why? Because if rates drop significantly below your current rate, refinancing can save you thousands. Set up alerts on financial news sites for mortgage rate updates. Check Freddie Mac's weekly primary mortgage market survey. Know your current rate and calculate what a lower rate would save you monthly. When the savings are substantial enough to justify refinancing costs, make your move. And here's something most people don't realize. You can refinance more than once. If rates keep dropping over time, you can refinance again and again, as long as the math makes sense each time. Some homeowners have refinanced 3 or 4 times over a decade, each time locking in a lower rate. Treat your mortgage like an active financial tool, not a set-it-and-forget-it commitment. Let me list the biggest mistakes people make with mortgages so you can avoid them. Mistake number 1, not checking their credit score months before applying. By the time you're ready to buy, it's too late to fix major credit issues. Start at least 6 months early. Mistake number 2, making large purchases before closing. Buying furniture for the new house on credit before you've closed the deal can change your DTI ratio and potentially cost you the loan entirely. Wait until after closing to make big purchases. Mistake number 3, not getting pre-approved first. We already covered why this is essential. Mistake number 4, choosing a loan based solely on the lowest monthly payment without considering total cost. Mistake number 5, skipping the home inspection to save money and then discovering major problems after purchase. And mistake number 6, using all your savings for the down payment and having no emergency fund left. Always keep a financial cushion. Life happens. Repairs happen. Having no reserves after buying a home is one of the fastest paths to financial stress. Equity is the portion of your home that you actually own. It's the difference between your home's market value and what you still owe on the mortgage. Building equity is how homeownership creates wealth, and there are ways to build it faster. First, make extra principal payments whenever possible. We covered this. Second, choose a shorter loan term. Third, make home improvements that increase the property value. A kitchen renovation that costs $15,000 but adds $30,000 in home value just created $15,000 in instant equity. Fourth, avoid taking out home equity loans or lines of credit unless absolutely necessary. Every time you borrow against your equity, you reduce it. And fifth, time. Real estate historically appreciates in value over long periods. The longer you own, the more equity you typically build through both payments and appreciation. Patience combined with strategic payments is the formula for mortgage wealth. Should you trust mortgage rate forecasts? With a grain of salt. Fannie Mae projected rates ending 2026 at about 6.2%. The Mortgage Bankers Association expects rates to remain between 6 and 6.5%. These are educated guesses from very smart people, but they're still guesses. Remember, the 2024 forecasts were significantly off. Economists predicted rates might hit 4.25%, and they never even got close. Economic shocks, policy changes, geopolitical events, all of these can derail even the best forecasts overnight. Use forecasts as general directional guidance, not as precision tools. If most experts say rates will trend lower over the next year, that's useful context for your decision. But don't wait for a specific number. The best rate is the one you can get today when you're financially ready. You can always refinance tomorrow. You can't always find the perfect home tomorrow. Let me talk about something nobody discusses in mortgage videos: the emotional factor. Fannie Mae's behavioral research found that many buyers feel comfortable or satisfied with the first quote and stop shopping. This is a behavioral trap called satisficing, settling for good enough instead of finding the best. It's like ordering the first thing you see on a restaurant menu because you're too hungry to read the whole thing. Yes, it satisfies your hunger, but you might have missed a much better dish 2 pages later. The mortgage process is stressful and complex, and our brains naturally want to simplify by choosing quickly.
Fight this instinct. Take your time. Compare multiple offers. Don't let the emotional exhaustion of home buying lead you to overpay on the largest financial transaction of your life. The extra few hours of shopping could save you tens of thousands of dollars. Is that worth it? I think you know the answer. Here's something fascinating. The 30-year fixed-rate mortgage is largely an American invention. Most countries around the world use adjustable-rate mortgages or shorter fixed terms. Academic research from the Supreme Court Economic Review noted that the United States is unique in the world for standardizing on a mortgage with these features. In countries like Canada, fixed rates are typically locked for only 5 years. In the UK, 2 to 5 year fixed terms are standard. In Germany, rates might be fixed for 10 years. The American 30-year fixed mortgage offers unprecedented rate security, but it also comes at a cost to both consumers and the financial system. Why does this matter? Because if you're buying property in a different country, or if you're comparing the American system to your home country, understanding these differences is crucial. The American system offers more protection from rate changes, but at a higher overall cost. Other systems offer lower initial rates, but more exposure to market fluctuations. There's no universally best system, just trade-offs you need to understand. Technology has transformed the mortgage industry. Online lenders now offer instant rate quotes, digital applications, and faster closings. Many lenders allow you to complete the entire process from your phone without ever visiting a bank branch. This has increased competition and put more power in your hands. 15 years ago, getting a mortgage quote meant calling banks one by one, scheduling appointments, and waiting days for responses. Today, you can compare 10 different lender rates in 30 minutes while sitting on your couch. This makes shopping around easier than ever, which means there's no excuse not to do it. According to CFPB guidance, be cautious with online comparison shopping platforms. Some platforms rank lenders based on who pays the highest referral fee, not who offers the best deal for you. Always verify rates directly with lenders and don't rely solely on comparison site rankings. Technology is a tool. Use it wisely. Mortgage rates are just one piece of the home ownership puzzle. The real wealth in real estate comes from the long game. Over decades, home values tend to appreciate, your mortgage balance shrinks, and your equity grows. This combination creates financial security that few other investments match. LendingTree analysis of Federal Reserve data shows that American households held $35.8 trillion in real estate equity through the second quarter of 2025. That's a $200 billion increase from just 1 year earlier. Homeownership remains one of the most reliable ways to build generational wealth, but it requires patience. Home values don't go up in a straight line.
There will be dips, corrections, and flat periods. The homeowners who build the most wealth are those who buy responsibly, maintain their properties, make consistent payments, and hold through market cycles. Don't think of your mortgage as a burden. Think of it as a forced savings plan that builds wealth while giving you a roof over your head. All right, let's bring it all together. Here is your step-by-step action plan. Step 1. Check your credit score today and begin improving it. Aim for 740 or higher. Step 2. Start saving for a down payment. Target at least 10 to 20%. Step 3. Reduce your debts to lower your DTI ratio below 43%. Step 4. Gather all your financial documents 6 months before you plan to buy. Step 5. Get pre-approved with at least 3 different lenders. Step 6. Compare offers using APR, not just interest rates. Step 7. Lock your rate when you find the best deal. Step 8. Budget for closing costs of 2 to 5% beyond your down payment. Step 9. Maintain your financial profile. No big purchases, no new credit applications until after closing. And Step 10. After you close, continue monitoring rates for refinancing opportunities, make extra principal payments when possible, and think long-term. This 10-step plan, combined with everything you learned today about how mortgage rates work, puts you in a position that most homebuyers never achieve. You now have the knowledge. The only thing left is the action.
If you watched this entire video, congratulations! You now understand mortgage rates better than 90% of people who already own homes. You know what drives rates up and down. You know how your credit score, down payment, loan type, and timing all affect what you pay. You know how to shop, negotiate, and protect yourself from overpaying. Remember the stat from the beginning? Over $13 billion in mortgage overpayments every year, simply because people don't know what you now know. Almost half of all borrowers don't shop around. A single credit score improvement can save over $62,000. This is not theory, this is your money. So go out there, check your credit, start saving, do the work, and when the time comes to buy your home, walk in knowing that nobody is going to take advantage of you, because you did what most people never do. You educated yourself, and that is the most valuable investment you'll ever make. Thank you for watching. Now go build your future